Morgan Stanley have made the call that the US dollar is set for a 7% rally versus the euro through the back end of this year. This is the latest piece of Forex and stock market news that I want to draw your attention to. And in today's video, I'm going to show you the US macroeconomic data, which suggests that the US dollar is in fact set for a comeback. Morgan Stanley sees the euro sliding 7% on risk of big ECB cuts. US Bank's FX strategy head forecasts euro dollar near parity, says growing political risk, economic weakness will drive move. Morgan Stanley sees the euro sliding towards parity with the dollar within months on the risk market's move to price in more aggressive policy easing by the European Central Bank to tackle a faltering economy. So you can see here already they're talking about this on the ECB side, not the Federal Reserve side. I'm going to show you why on the US side this looks to be the case as well. But on the ECB side, what they're saying is that the European economy is really in a bad place, and they're going to, and when I say they, I mean the ECB, are going to need to ease monetary policy harder and faster than many people are expecting. The US Bank expects the single currency to slump to $1.02 by the end of the year, a roughly 7% depreciation from current levels. That view rests on markets betting the central bank will press ahead with interest rate cuts at the next 3 meetings, along with a potential of a jumbo half-point move. If data continue to deteriorate further in Europe, and we're going to have a look at that next, the market has to start thinking about not just 25 basis points a quarter, but maybe 25 basis points every meeting, or perhaps even the risk of a 50 basis point cut, much in the same way the market has applied concerns about a slowdown in the US to a faster and deeper cutting cycle from the Fed. So what they're saying is they expect the dollar to rally 7% against the euro, for the euro to fall to parity. And this is primarily on concerns around the German economy in Europe and also the European economy as a whole, but specifically Germany. And so what is the latest data out of Germany, out of Europe looking like? Well, if we head back over to Bloomberg for this article yesterday, you can see German investor confidence just out plummets after spate of bad news. ZEW expectations index drops to 3.6 in September, estimated at 17. Hope for a swift economic improvement is fading. Investor confidence in Germany's economy plunged to its lowest level in almost a year after further signs that the country's manufacturing giants face an increasingly uncertain future. The surprisingly quick deterioration in sentiment is the latest evidence of a souring outlook, arriving just after Intel Corp said it plans to postpone a planned factory by about 2 years. So this being the news that Intel have basically delayed the building of their new factory in Germany. And all of this goes to point on the side of the euro weakening. So again, we're going to have a look very soon about why the dollar in and of itself is likely to start strengthening. But I'm looking at the other side of this trade as well, because we should have supply on the euro side, and that should coincide also with demand on the dollar side. And this is what can really drive the dollar higher in the near future. The article goes on to say the hope for a swift improvement in the economic situation is visibly fading. And although the falling economic expectations for the Eurozone point to an overall rise in pessimism, the drop in expectations for Germany is significantly greater. The bigger than expected drop in the ZEW index adds to the recent stream of negative news for the German economy and makes another GDP decline in the third quarter more likely. And what does that mean? Well, if you look at the GDP growth rate for Germany quarter on quarter, you can see in Q2 there was a contraction of GDP. So in all likelihood, we are now looking, with that recent data out of Germany yesterday, at Germany, Europe's largest economy and one of the largest economies in the world, being in recession with quarter-on-quarter contraction GDP growth Q2, and now looking likely to see another contraction in GDP growth in Q3. And as you can see from this graph, the article also goes on to say the current assessment of the situation is now almost as bad as it was at the beginning of the COVID pandemic in spring 2020. So again, what this is likely to do is cause the ECB to have to ease monetary policy faster and harder than people were expecting. And this is going to create supply of the euro. And don't forget, the euro makes up 57% of the dollar index. So without the dollar going anywhere, if the euro starts to get sold, or there's an increase in supply, this is going to push up the price of the US dollar relative to it anyway. But let's now go and have a look at this on the US side, because I want to show you, based on the macroeconomic data in the US, it looks like we're also not just about to see an increase of supply of the euro on the one hand, because of a weakening German and EU economy, but also we're going to see, in all likelihood, demand starting to come back in for the dollar itself, giving us this setup of an increased supply in the euro and at the same time increased demand for the US dollar. Okay, so the first piece of data I want to draw your attention to is the DXY versus the unemployment rate. So what we're looking at here is we're looking at how the US dollar responds or reacts to changes in the unemployment rate. And what you'll see here, not just with the unemployment rate, but other data we're going to look at, is that the dollar tends to respond to macroeconomic data in what's known as the dollar smile. And you can see that outlined by that annotation I've drawn on there, the pink or purple kind of smile. And this shows that what happens with the dollar, and on the left hand side we've got the US dollar year over year, and down the bottom on the x-axis we've got the unemployment rate year over year. And what this is showing you here is that the data tends to respond, or the dollar tends to respond in terms of this smile. In other words, when we have the unemployment rate, you know, kind of not really doing too much, there's not really much change year over year, you could say between -20 and +20. This tends to be what's known as the kind of danger zone for the dollar. In other words, you see a lot more underperformance from the US dollar when you have the unemployment rate kind of sitting in that middle ground between -20 and +20. Now, what you'll also see is once you start to go either side of that, in other words, once you start to cross -20 on the left-hand side, and this shows a real tightening of the unemployment rate, you tend to see the dollar start to overperform. And in fact, you can see on the left-hand side of -20, most of the data points are up at 10 and 20. And we have very, very few data points where we see a weaker dollar. And what you'll see here is that once you start to move past -20 on the left-hand side, really all of the data points are higher up in terms of the US dollar on the y-axis getting stronger. So when we see a very tight labor market on the left-hand side, we see the US dollar outperforming. When we see a very loose unemployment rate, which is on the right-hand side, so when you start to pass +20 down on the bottom of the x-axis on the unemployment rate. In other words, once the unemployment rate really starts to loosen, you also tend to see an outperformance of the dollar. Now, you will see there's quite a number of data points on the right-hand side which are below zero, so the dollar can weaken. But what's very noticeable is the dollar really struggles on the right-hand side when you get a loosening of the unemployment rate to post results, you know, near -20. Whereas to the upside, you can see it's actually skewed to the upside. In other words, when you start to get the unemployment rate going from 40 to 50 to 60 to 80, if the dollar is down, you know, it's only down maybe -10 or less so, between 0 and -10. But when it's up, you can see it, you know, +10, 15, +20. So the first thing then to really notice is that the dollar operates on what's known as the dollar smile theory. If you have a very strong economy, the dollar tends to outperform. If you have a very weak economy, the dollar tends to outperform. And if you have a kind of in the middle Goldilocks economy, you tend to see the dollar underperform. And if you look at the most recent data point, this orange data point here, this is sitting right in the middle of the 0 and the +20. However, there's a couple of things really important to notice here with the unemployment rate, i.e. where we are coming from. If you take the green dot here, the green dot is the previous data point, so not the current data point, but the one before. And you can see we started to post an unemployment rate past that 20 bound on the right-hand side. And what this is telling us is we're starting to really see the unemployment rate loosening in a way that is consistent not just with a weaker economy, but with the US dollar also outperforming. And if you have a look finally at the black dots, you can see this was when the unemployment rate in the US troughed, and we had a very, very, very tight labor market in the US, and the US dollar was posting results between kind of 0 and -10. And look at the direction of travel. It's from the left-hand side to the right-hand side. So when you look at data, data often tends to overshoot. And what this means is, just looking at this, and I'm going to show you more data to give us an idea of where the unemployment rate is going. But just looking at this, just looking at the unemployment rate, you can see we've got that pendulum swinging from the left-hand side, a very tight labor market, to the right-hand side. And now, although the current data point was more back in the middle, we have started to see data points coming in past that all-important +20 unemployment rate year-over-year change, which tends to coincide with a stronger US dollar. Okay, so you may be asking the question, well, We did get that print to the right hand side of the plus 20 barrier, year over year change in the unemployment rate, and this is suggesting we should start to see upward pressure, but the last print came back in the middle. So how do we know we're going to continue to get prints on the right hand side, which is dollar bullish, and not continue to get prints in the middle like we did with the last print, where actually this is dollar bearish? What I want to do now is I want to show you 3 charts which answer that question and show you why on a leading basis we should expect the unemployment rate to continue to loosen over the back end of this year and into Q1 of 2025. Okay, so the first chart that I want to show you is the Kansas Fed Labor Market Conditions Index, in this case inverted, so I've turned it upside down, versus the unemployment rate. On the left-hand side, I have plotted the unemployment rate, that is the blue line, and on the right-hand side, I have plotted the Labor Market Conditions Index, and that is the orange line. Now, what we see here is that when labor market conditions get better or tend to get stronger, this leads the unemployment rate getting tighter. And when labor market conditions deteriorate, this leads the labor market in the US or the unemployment rate to deteriorate. Now, what we're seeing here with the orange level, in other words, the labor market conditions index, is it's peaked and it's started to now come back down below the 0.50 level. In this series, of course, it's bottomed and it's moving back above it again because I've inverted it. But historically, when we see the Kansas Fed Labor Market Conditions Index peaking and then starting to trade below the 0.50, and again, in this case, you can see the orange line moving up to show that, this tends to historically always precede an unwinding of the labor market. You can see this back in 2001. You can see this back in 2007 into 08, and you can see this again in 2019 or 2020 with the COVID crash. So the last 3 recessions that we've seen in the US, 01, 08, 2020, they have coincided with the Kansas Fed Labor Market Conditions Index breaching the 0.50 level, and that has preceded a rapid unwinding of the unemployment rate and a recession in the US. Now we know that we're already starting to get prints to the right hand side of that plus 20 year-on-year change in the unemployment rate. As the labor market continues to unwind, this is going to see higher prints on the right hand side, 50, 60, 70, 80, 90, 100. And this is consistent with a recession in the US, which historically will bring with it strengthening of the US dollar. Okay, so the next chart that I want to show you is the NAHB Housing Index, another leading macroeconomic indicator of the unemployment rate. I've inverted the unemployment rate once again, so that both lines are moving in the same direction. The unemployment rate is in blue. I've labeled this on the left-hand side, and the NAHB Housing Index is the orange line, and I've labeled that on the right axis. Now, the interesting thing with the NAHB Housing Index is you can look at either 5 signals or 3 signals. If you take the first 5 signals, whenever this trades down below the 50 level on the right-hand side, this has tended 4 times out of 5 to coincide with a rapid unwinding of the unemployment rate and a recession. We see this right at the back end of the 80s. We see this in 95, which is the much fated Greenspan soft landing. So there is no recession in 95. That's a false signal if you're looking below the 50 level. We see the dot-com crash trading below 50, and we get that rapid unwinding of the unemployment rate and a recession. We see the NAHB Housing Index in 2008 dropping down below the 50 level, and we get the rapid unwinding of the unemployment rate. And we see the same thing happen in 2019, 2020 with COVID. Now, we are trading not just below the 50, but also below the 40 level. And this is where you can actually drill down into those signals a bit more, because each time we've traded below the 40 level, we've seen a recession and an unwinding of the unemployment rate. And even if we take all 5 signals, and we add in the false signal of the Greenspan soft landing, we can look at other things with that. We can say that we didn't have, the yield curve inverted like we have now. We didn't have inflation, hitting 8.5%. It really only went to sort of 3%. At the time, we actually had the unemployment rate tightening into that soft landing. We're actually already seeing the unemployment rate unwinding. So if you take the totality of it, there are other pieces of macroeconomic data which can very easily cut out the difference between what's happening now in the prior recessions and also in the Greenspan soft land of 95. However, you can see trading below the 40 level does indicate historically a rapid unwinding of the unemployment rate. And the third chart that I want to show you is the US unemployment rate versus the 10-year, 2-year spread. So that's the 10-year yield and the 2-year yield, and the difference between the two versus the unemployment rate. The unemployment rate in blue, once again, plotted on the left-hand axis, and the 10-year, 2-year yield spread is plotted on the right-hand axis and also in orange. So what you can see here very clearly is we've had this yield curve inversion. And many of you will know this indicator, an indicator that goes back, in this case, all the way into the 70s, the data for. And every single time we get the yield curve inverting, we tend to see a recession. And as the yield curve steepens, you can see this coincides with an unwinding of the unemployment rate. And very often, it's when the yield curve starts to go back above zero. In other words, it starts to go back into positive territory, having been inverted. This tends to always coincide with a rapid steepening of the unemployment rate. And as you can see, we are yet on a monthly closing basis to actually turn positive. So it means that a rapid unwinding of the yield curve is ahead of us, and the current troughing and bounce from the roughly 3.5% that we've seen in the unemployment rate should not be considered the entire move, and we should be expecting a lot more unwinding to come in the unemployment rate and, in this case, a recession. Okay, so we've just looked at three charts which tell us in all probability there is a rapid steepening of the unemployment rate ahead of us, not in the past, ahead of us. And with that, we've already seen earlier on in the video how this is going to be supportive of the US dollar. What I want to do now is have a look at where that unemployment rate could be going. If we pull up this chart with the JOLT, so job openings, and this is known as the Beveridge curve. The Beveridge curve really is the job vacancy rate versus the unemployment rate. We're actually looking at the JOLTs year over year and the unemployment rate down the bottom year over year as well. And what you can see is this. We have, with the orange dot, the most recent print for both job openings and the unemployment rate. And you can also see in the green dot, we have the print, not the current print, but the previous print before the current print. And both of those are quite clearly below the zero bound on the y-axis, in other words, for job openings. So we're starting to see job openings come in negative on a year-over-year basis. And as you can see from this data, what that means is we start to see a skew towards the unemployment rate unwinding at a faster and faster rate. In fact, when you start to see JOLTs printing year over year, negative 30 or more, which we're very close to, we're not quite there, but we're very close to it. And I would posit that with everything else we've looked at, that will be coming up in the very near future in the coming months. Once JOLTs start to print negative 30 plus year over year, we are going to start to see the unemployment rate printing in the territory of 75, 80, 100. You can see up to 150 as well, you know, when you start to look at those outliers. The other thing as well, earlier on in the video, I said that data tends to overshoot, swings like a pendulum. Look at the black dots on the left-hand side. This was where we troughed most recently in the unemployment rate. And you can see in the top left-hand corner of the chart, we have swung all the way from there down to, again, the most recent print is that orange dot that you see. And this implies that we should be expecting, again, an overshoot to the right-hand side and also below that negative 30 bound in job openings. Okay, so I want to finish off with a few more charts that I think are very important for how the dollar could be supported over the next few months. And then we're going to go and have a look, and we're going to swap out the fundamentals, the macro, for the quantitative. Have a look in the Hedge-Quantitative Analytics platform. And I'm going to show you exactly where I think we could be seeing a bottom in the US dollar. So if we're going to see the unemployment rate above 50, 75, 100 on a year-over-year basis or even further, what does this mean for inflation? Well, the Phillips curve shows the relationship between inflation and the unemployment rate. Again, in this chart, we're looking at CPI year-over-year though, and the unemployment rate year-over-year. But you can see once we start to pass the 50 bound of the unemployment rate on the x-axis, inflation starts to print sub 2%. So if we're going to see a continued unwinding of the unemployment rate and we're going to see it moving past the positive 50 barrier, this is suggesting we should be expecting a sub 2% inflation rate on a year-over-year basis, and potentially, as you can see, a negative or deflationary print. And so if we're going to get a sub 2% print in CPI, what does that mean for the dollar? Well, if we bring up the DXY versus CPI year over year, you can see that smile is back. In other words, when we have very low CPI, the dollar outperforms, and when we have very high CPI, the dollar outperforms. But when CPI is just right, just in the middle, then we don't actually see an outperformance of the dollar. We tend to actually see an underperformance of the dollar. So if we're going to get CPI coming out as the unemployment rate starts to pick up year over year and we see inflation printing sub 2%, where does that put us in terms of the dollar? You can see once we start going below 2% in inflation and certainly below 0% or into deflation on a year over year basis, we see the dollar skewing to the upside. This is where we start to get dollar bullish once again because the data is coming out so weak that we tend to start to see a flight to safety. Okay, so the final piece of data I want to show you is on GDP. We've got the relationship between real GDP and the unemployment rate known through Okun's law. In this case, as I have been throughout the video, I'm using real GDP year over year on the y-axis, unemployment rate year over year on the x-axis. And you can see if we start to pass that positive 50 reading year over year in the unemployment rate, as all the data I've shown you today suggests we're going to, we start to see GDP skewing into negative territory and we start to see GDP printing negative 1, 2, 3, 4. This is a recession. So what we're looking at here, the data is predicting a coming recession and a sharp unwinding of the unemployment rate in the US. So finally, what does that mean for the DXY? Well, we've got that smile back when we measure DXY versus real GDP on a year over year basis. And again, if you start to see GDP printing sub 1%, certainly turning negative and contracting, we once again see the dollar skewing on the left-hand side towards outperformance. So this really confirms everything else we've looked at. Not only should we be expecting a rapid unwinding of the unemployment rate ahead of us, we should expect CPI to crater, and also we should expect GDP to potentially contract. And one of the beneficiaries of this will be the US dollar. Okay, so wrapping up the video very quickly with a quick look in the HedgeDash quantitative analytics platform, because I want to overlay some of these quantitative levels with the fundamentals we just discussed. If we're going to see data coming out very weak over the back end of this year and into Q1 of 2025, where could we start to see a bottom in the dollar forming quantitatively, technically? Well, we of course have the major technical low over here, and we're looking on the weekly chart of the DXY. We also have coming up in not very long, just an hour or so, the FOMC meeting where the Fed are expected to cut 25 or 50 basis points. So we're bound to get some volatility. But after the dust settles, if we break the 100.33, this is the second quarterly lower bound. What that means is it means we have roughly, the markets are pricing, a 95% chance of finishing the quarter above this level. Now, of course, with the catalyst, FOMC, we could see it pushing a bit lower, but that is a very, very, very good support area to start to look at, the 100.33. If we get volatility, we'll probably blast through it, but don't be surprised to see the market trade under it for a little bit and then reverse over the next few weeks even. That wouldn't surprise me at all. The second level here is the 99.92. This is the monthly first lower bound. So now we have a 70% chance below the 99.92 of closing and reversing above it this month. And if we trade down below the 100.33 and the 99.92, we also have a 95% chance priced by markets of the dollar index reversing higher over the back end of this month. So two very key levels there on a bigger time frame, and I would not be surprised to see us trade through the 100, through the 99.92, take out this low, and then start to try and form a bottom in the dollar as some of that data comes in soft. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge HedgeDash trading app used in today's video by heading over to www.hedgedash.com. Access to the cutting-edge HedgeDash platform is included with every GMT membership.